Awesome.
Pull up bigger pockets and read from there. Got enough, right?
All right. Well, welcome to class on this beautiful summer day. Tonight is 1031 Exchanges, and as James would like to note, adding to the title, for real estate investors, as opposed to, I don't know what else it would be.
It's for when people search online so that it comes up.
I understand. Okay. Is your mic on?
It is on.
Because it's not projecting your voice.
Is it projecting my voice now?
Yeah.
What about now?
Yeah. So I'm out of town for the next 2 weeks because otherwise I'd be teaching all these classes. I'm also out of town here. So James is really only teaching this class. I'm technically teaching these, but I'm out of town. So James, why don't you tell us about what's going on the next month?
I am teaching the class on the 4th of July. That's the one that counts for me.
Why don't you tell us about the rest of them, though? They're all you.
So the one next week, the best real estate investing strategy ever. How many people know what the best real estate investing strategy is?
Come here.
Yeah, you have to come here to find out. Because we will tell you exactly what it is next week. It's going to be amazing.
Make money?
It's gonna make money. It's going to be really, really good. So that is a class that we haven't taught in a very long time. We will teach that one. And then the week after that, how many people know what house hacking is? Anyone not know what house hacking is? Raise your hands really high. How many people don't know what Nomad is? Everyone knows what? Okay, so it's a couple people. So come to that class. We're going to tell you what house hacking is and what Nomad is. It's going to be amazing.
Keep going.
Oh, I got more. And then interview with Mr. F. You are actually doing this one, aren't you?
No, it's you. We've discussed this.
Okay, well, apparently Mr. F is being interviewed. How many have come to any of the interviews before? Anyone see Mary's interview? If you missed Mary's interview, it is awesome. It's available on the podcast. Really, really good stuff. And then we've had a bunch of different interviews. Brian did one. Royce did one.
Daryl did one. Wes did one.
Yes. So we had a whole series of interviews. This is an extension of that. It's going to be Mr. F doing an interview on
and it's
July.
not going to be recorded. So if you don't see it live, you will not be able to hear it.
Yeah, so it will not be recorded, not be on the podcast, not be on the website, nothing like that. And then it's been a long time since we did a new update for investor financing, so I'm going to do a whole class on all the different financing strategies for real estate investors. It's good for first-time home buyers, first-time investor buyers, multiple investor buyers, very advanced investor buyers, and we'll maybe even do a little creative financing if I have time. And that's going to be on July 17th. And actually, that's Brian's presentation. Why am I teaching that?
What? Because you stole it.
Oh, okay.
He basically took my presentation and took my smiley faces out, and now he calls
I
it
left
his
your
own.
smiley faces in.
Yeah, you did. So I'm not sure if this class is going to run long or not. If we do intros and they take a while, it might run long. But we're going to try and do intros tonight since we skipped them last week. So tonight's question, introduce yourself. Have you done a 1031 exchange? And if you have, was there any surprise during your 1031 exchange? James, start us off.
I am James Orr. I'm a real estate broker. I do all sorts of real estate investing. Have I done a 1031 exchange? I have not done a 1031 exchange. So no, and there were no surprises during the process for me.
Nice.
My name's Kim Bork, and I want to do a 1031 exchange. And so I'm here to find out how to do that without winding up in jail or something.
Wow, nice.
My name's Alex, and I have not done a 1031 exchange.
Perfect.
My name's Doug, and I have not done a 1031 exchange.
My name's Dan, and I have not done a 1031.
Sweet.
My name's Mark, and I have not done a 1031.
My name's Dustin. I've not done a 1031, but I've been involved in 2 transactions. One with the other party was 1031.
My name's Eva, and I had a humiliating experience trying to prepare a tax return with a 1031. I am a CPA, and doesn't necessarily mean you know everything brilliantly.
Carol, I have not done a 1031.
I'm Julie, and I needed to do a 1031 at the beginning of this year, but I had already purchased the property.
Hello, I'm Ken. I have not done a 1031. I've just read up on it a little bit.
Cool.
I'm Bob. I have done 1031 3 times. Yeah. The first one was particularly challenging because we were selling one property and buying 3, which is the difference between California and Texas.
Yes.
Yeah. My name is Ali. I haven't done
Keith.
1031.
So we do use the microphone for recording the podcast. So if you guys do your response, it does not project your voice, but it does record for the podcast. And if you don't speak into it, I get complaints.
My name is Ali. I have not done 1031. Are you happy now?
Well, it's not for me. You guys are the one that complained to me. You're
Yeah.
like, I can't hear people in the crowd.
When you listen to the other podcasts that you're not in class for, and you're like, I can't hear that what that person says.
The ironic thing is we can't hear you say that.
Exactly. No one can hear me say it either. So.
Yeah.
My name is Aubrey. I also have not done a 1031.
Hi, I'm Royce. I am a long-term buy and hold investor here in Northern Colorado. I have not done any 1031 exchanges.
You're too busy moving around.
That is right.
Hi, I'm Nick, and I have not done a 1031.
Hi, I'm Jackie. I have not done a 1031.
I'm Al. I have not done a 1031.
I'm Laura. I have not done a 1031.
I'm Lynn, and I have not done a 1031. Regretfully, I've sold rental property and then found out my big mistake at tax time.
I'm John. I've not done a 1031.
Perfect.
I'm Bob. I'm back. Bye.
I'm Mike. I have done a 1031 exchange.
You have or you haven't? I have. Nice.
I'm Emily. I have done a 1031 exchange. It was a little stressful, kind of that you have to pick out a new property within a certain amount of time, but overall it went pretty smoothly.
Perfect.
I'm Kevin and I have not.
I'm Caroline, and I have not done a 1031 exchange, but plan to in the future.
Hi, I'm Denise. We've done 2.
I'm with her, so we've done 2.
I'm Bob, and we have not done a 1031 exchange.
I'm Barbie.
I'm Austin and have not done one.
I'm Michelle, and I've also not done a 1031.
Perfect. So most of you have not done a 1031 exchange. I've done a couple 1031 exchanges and a lot of research in addition to those. So tonight's class, if you were here, I don't even know when we taught it, 2017, like in October, something like that. So it's been like almost coming up on 2 years since we've actually taught this class. The class tonight is updated significantly from that class. So there's a bunch of extra stuff in here. If you were here last week, same disclaimer, it's a little shorter. I'm still not a CPA, an attorney. I'm not a 1031 professional. Everything in here is intended to be true and correct, but if you use it for advice, don't. You can get yourself in trouble. Go consult a professional like James. Consult James.
Do not consult me about 1031 exchanges. I will refer you to a 1031 exchange company.
So how many of you feel like you know what a 1031 exchange is by show of hands? Perfect. So why are you here? Why is this class so full? If you already know. So essentially, a 1031 is when a business or investment property is going to be sold and you want to defer your taxes that you were going to have to pay. And that's an amazing thing. So instead of having to pay all of your taxes on the gains that you've made on a property, you can defer those taxes. That's what the IRS will let you do. This is called a 1031 because that is the section of code in the Internal Revenue Code that it is called. It's section 1031. Because otherwise, sometimes you're like, if you ever hear like, oh, are you doing a 721 exchange? Chances are high it's section 721 in the IRC. Normally, you would have to pay those taxes. 1031 basically grants an exception. You get to postpone paying tax on the gain if, right, big if, you reinvest the proceeds in a like-kind exchange. So do you think I could sell a rental property and buy a car and defer my taxes? No, why not? Because it's not like-kind, right? The deferred tax isn't like, hey, you just never have to pay it. And we'll tell you, like on the very last slide, I'll explain to you how you never have to pay the tax, but it involves dying. So there's that. So, you know, if you want to just jump straight to the end, never pay taxes, die. That's the story. Basically, you're deferring your tax. This can be done from all types of individuals and entities, right? You don't necessarily have to be something specific. You just basically have to be a tax-paying entity. Make sense? Because if you're not a tax-paying entity, you probably wouldn't have to pay taxes to begin with. Must be distinguished from simply selling one property and using the proceeds to purchase another property. So I can't just say, hey, I sold this property like a year ago and I used the money later to buy this other awesome property. That's not a 1031 exchange. There's some very specific rules that are put around 1031 exchanges. If you did this, it's taxable, right? to qualify, basically you need to have a transaction where the parts in the transactions are dependent on one another, and there's a contract that actually says that does that. Most of these are done through an exchange facilitator. Most of the time you'll hear it referred to as a QI, which is a qualified intermediary. So they're basically handling the money and handling the transactions, drawing up the documents for you. IRS basically issued safe harbor regulations in 1991, and prior to that, you could still do a 1031, but the exchange that you did had to basically stand on its own merit. So the IRS could say, hey, we noticed that you sold a property and bought another one. You're going to need to prove to us that you're allowed to defer those taxes on a case-by-case-by-case basis. So in 1991, they said, hey, we're actually going to tell you exactly what you need to do so that it qualifies as an exchange. That makes sense? Perfect. Did you know that?
I did not know 1991. I know at one point you actually had to do it. There was no time delay. It actually had to all happen at the same time.
Yeah, that's one type. So basically what happens in a practical manner is that an exchanger signs an assignment of contract, which assigns your contract to the intermediary, and then an exchange agreement, which details the terms of the exchange. This is the house I'm selling, these are the properties I'm buying, etc., gets filled out. That's the basic. So there's a couple different types of exchanges, and this will make a whole lot more sense. There's a simultaneous exchange. What do you think this might be? I know you know what it is.
Exchanges that happen over a 6-month period?
Royce, can you please take the mic from James? Simultaneous exchanges, this is the simplest exchange. However, the chances that you ever do one of these are really about zero. This is essentially what's known as a deed swap. James has a property that I want, I have a property that he wants, and we decide, hey, let's switch, right? What are the odds of that happening? Probably pretty low, right? You don't need a QI to do this because it's literally, hey, I'm going to deed you my property, you're going to deed me yours. But obviously it's hard to find somebody who wants exactly what you have and vice versa. Delayed exchange, right? This is much more flexibility. It's very, very common. This is probably the one that you're here to learn about. You sell one property, and then you buy a property or more than one property later in a delayed time frame, not simultaneous, as James apparently doesn't know the definition of that word. This is super common for real estate investors. You'll hear about, hey, I'm selling my duplex and I'm going to buy a fourplex. But I sold my duplex 2 months ago and I'm buying my fourplex in a month. Next type is a reverse exchange. So these are much more complicated, but they're pretty cool. So if you, see, that's much more complicated. Look at that, right? This is where you actually acquire the property that you want to buy and replace with your old property before you sell the property that you were actually going to sell to replace it with. And you're like, well, how on earth is that possible? Well, I'm going to explain it. Here's the overview. Your qualified intermediary, I'm going to just call it QI. Everybody knows what QI means now? Qualified intermediary. The QI basically sets up an exchange accommodation title holder. It's called EAT, which is weird, because as I went back and read the slides, I was like, this just looks weird. I have EAT everywhere, right? Basically, they set up an entity, and that's what it's called. They basically step in, they buy the new property, but it's titled in the name of the EAT. Think of the EAT as like an LLC, right? The lender then loans to the EAT. So you can get financing on that new property, which is pretty amazing, because you don't really own it yet, right? But the lender is likely to give you 100% financing because they're going to look at the property that you're going to sell, and they're going to put a lien on that, and they're going to look at the property you're going to buy, and they're going to put a lien on that. So in many cases, you can get 100% financing during this portion for the EAT. James is queuing up his questions. If it's not 100%, you have to show up with extra funds, right? And then if you do that, basically what you're doing is you're lending, say you needed to come with 100K, you're lending $100,000 to the EAT, right? Think of the EAT as just an entity, like an LLC, and that becomes the second lien on the property because the lender is, of course, taking the first lien. When the relinquished property sells, so you've now purchased the property you wanted, but you still had your old one, and that old one now sells, what do you think happens? Right? First thing that gets paid back is the second lien. Any money that was loaned from you to the EAT. And then the loan gets paid down on that property with the rest of the funds. So then you basically end up with your new property with a first lien from the bank on it, and you're good to go. 2 changes you're probably going to want to make to the loan docs, right? Which might be a little more difficult because changing loan docs is hard. You want to make sure there's no due on sale clause because this property is going to be transferred from the EAT into whatever entity your relinquished property was owned by. Otherwise, that would trigger the due on sale clause, allowing them to call the loan due. And then you're probably going to want to have a clause in there that says, I would like you to reamortize the loan once that old property is sold and we've paid this loan down. Make sense? Perfect. There's a couple rules that go with this. There's the 5-day rule. Basically, after the title's taken by the exchange accommodation title holder, so that EAT entity, you have to enter into an agreement, which makes sense. I would think you'd want to enter into this agreement before then, but you get 5 days. 45 day, the property be relinquished must be identified. So you could actually say, I found this amazing property and I own a bunch of other properties. I don't know what I'm going to sell yet, but I'm buying this, and the EAT takes possession. And then 45 days, within 45 days, you say, I'm going to sell that one and this one, and you can go sell those. And then, of course, the 180-day rule, everything needs to be wrapped up. 180 days seems like a lot of time. Let me tell you, it goes pretty fast when you're under the gun. In this particular case, it can actually take longer than 180 days, but then that safe harbor rule that we talked about doesn't apply, and the transaction must stand on its own merit again with the IRS. Any questions on that? I have not done one of these. Have you?
No, the comment were straight 1031 exchange cost $800 to $1,000.
Yeah, it's on my slides.
A reverse exchange cost $5,000 to $6,000.
Yeah, 4,500.
Could you say that on the mic?
Oh, yeah, it's on a slide later, so we're good. I do have costs. So I will tell you, the last time I taught this class, somebody at the end said the order of those slides were like difficult. Do you remember this? And so I went back and looked at the order. This is like self-directed 401ks last week. There's no possible way I can tell you everything before you need to know it. So just bear down and hang on. So types of exchanges. An improvement chain. What is this slide about? Oh yes, improvement exchange. So we've got the delayed exchange. Simultaneous exchange we're pretty much going to ignore. We've got a delayed exchange and we've got the reverse exchange. This one is super interesting as well. It's an improvement exchange. So as the name implies, this is where you would take a property, the QI would basically take possession, you would do improvements to the property to potentially raise the value to avoid boot, and I'll tell you what boot here is in a second. And then you get a higher appraisal value and you're able to acquire that property and not have boot. So I've never done one of these either. Anyone in the room done one? There you go. So what qualifies as like kind? Can I sell a condo and buy a duplex? Yes. Can I sell a duplex and buy vacant land? Some people saying no, some people saying yes, some people saying they don't know. Yep, you totally can. So what qualifies? Both properties must be held for use for investment or business purposes. This is key, right? It can't be, hey, it's my owner-occupied house, right, and I'm going to sell it and 1031 it. We'll talk about how that might work at the end of the presentation. Primary residence, secondary residence, vacation homes, all that stuff doesn't qualify. So if you're like, I'm going to buy a condo in Vail and 1031, not going to happen.
And one of the reasons why you may not even want to do that to begin with is primary residence. If you've lived there 2 out of the last 5 years, there's no gain on that up to a certain exclusion amount.
Yes, we're going to talk about that specific thing later because you actually can move back in to a house that you 1031 into and deal with it that way. Properties must be similar. This means the same nature, character, or class, but it could be a Class A apartment and a Class D apartment. It doesn't matter, right? It can be vacant land to a condo. It doesn't matter. Most real estate is like kind to other real estate. Residential house is like kind to vacant land. However, property in the US is not like kind to property outside of the US. That's one big exception. Improvements, and this one's a corner case. So improvements conveyed without land are not like kind to land. And this basically deals with leasehold interests and ground leases. So if you're doing anything like that, go consult a professional. We're not going to cover it in depth here.
So is condos then included in that?
No. That is why I specifically put that bullet underneath, because most of the time your condo doesn't have land.
Right, that's
but
why I
that's
asked.
not what that is stating.
Yeah, it's interesting.
Yeah. Because I read that and I was like, what? And so I went and did a bunch of research. Generally limited to exchanges of real property. Can't use fake property, just kidding. The reason that's in there is that it's real property versus personal property, right? Real estate versus stuff that you would own like a refrigerator. It used to be allowed, but this was removed in 2018 with that bill, in case you want to go look it up. Stuff that you cannot do. Inventory or stock in trade, stocks, bonds, or notes, other securities or debt, partnership interests. This one's key. I can tell you how to get around this later. If you are in an LLC and you're partnered with somebody, you cannot 1031 your partnership interest. And your partner says, I'm not 1031ing with you. And you're like, well, I'm going to 1031 my share out. You can't 1031 a partnership interest. I'll tell you how to get around it at the end. Certificates of trust and fix and flips don't qualify. So if you are a flipper, you're like, this is going to be awesome. I'm going to flip 4 houses a year, and I'm going to make $40K on each one, and I'm just going to 1031 this until I'm dead, and then hand it all to my heirs. It doesn't work like that. However, with the IRS, what's really key is that intent matters. So if you were intending to buy something and hold it for a long period of time, and then something happened where that circumstance changed, as long as you've documented that, that still may qualify for a 1031. It is the intent that matters. James and I, this also occurs when you're paying taxes with the IRS. James and I actually did a flip together, I don't even know when, 2013?
It was July 4th weekend.
14, yeah, I know. It was,
It's
coming up.
don't know what year that was.
I think it's 2014. So we did a flip together where the goal was we were going to take it down, we were going to fix it up, and we were going to rent it out. And the lender that I was using, they wanted me to sign some crazy stuff. I'm not even sure if they're in business anymore, but
probably for that reason.
Yeah, they wanted me to sign some stuff in addition to the normal deed of trust that was above and beyond what a deed of trust should say. And I was like, no. And so what happened was I was like, well, forget the lender. We're just going to pay cash and we're going to flip it instead. So it was intended to be a long-term rental hold, and it became a flip that we literally owned for less than 2 months. However, because the intent for me was long-term, on the taxes, it actually showed up as it was a rental property, but things changed. So it's a different set of taxes.
You didn't 1031 that, did you?
No. Did you?
I didn't.
Yeah.
I just cashed a check.
Yeah, you didn't do anything. You just waved your hand at me. Yeah, that's pretty much
That
what
was
happened.
a well-negotiated flip on my part, I have to say.
Yeah, sure was. So a word about cash out refinances. Oh yeah, we got a question back here.
Wait, question.
Mike is on its way.
Questions about the intent and what you said goes on the taxes as intent. How exactly does that go on taxes as intent? Do you declare something, or you have to write a statement, or what?
So you should consult your CPA, but for me it was, I was saying, yeah, well, she's not my CPA, so I can't speak for her.
It was a big hassle, so I'm saying, can you elaborate on what you said?
Well, she said she had a bad experience with the 1031 exchange, right?
Elaboration. I'm asking just elaboration on what you said.
Yeah, so for me, I would document it, right? When you go to buy the property, if your intent is to hold it as a long-term rental, I would write that down and send it to yourself in email or sign it and date it and scan it in, right? So that you've got your known intent. That way, if anyone ever asks, you can go, hey, here was the intent, and then here was the change in circumstance that actually occurred, and this is why the change happened. Now, if your intent is, I'm going to buy this as a long-term rental, and then you flip it and you 1031 it, and you do that once, it's probably going to slide. You do that again 6 months later, and then again 6 months later, and again, shit's not going to work out for you, right? It's not going to go well. So, cash out refinances. One of the great things about real estate is you build equity over time, you can pull cash out. You need to be pretty careful when you're thinking about cash out refis with 1031s. So, imagine you're about to sell this property and you're about to 1031 it. You got a whole bunch of equity, right? But you're going to 1031 into a new property and you're like, I'd like to get some of my cash out. Should you do it? Can you do it? You totally can. What's going to happen? So, if you do a cash out refi right before you 1031, the chances are high the IRS is going to look at that and go, nope, you're basically doing what's called a step transaction to skirt the rules. So instead of just following, hey, I'm doing a 1031, I can't take cash out at the closing table and use it to go pay my bills or whatever, you're basically stepping and saying, I'm going to do a cash out refi, and then I'm going to do 1031. You're stepping the transaction, which is against the rules.
Is there a time frame?
So don't do that. Yes, I'll get there.
Okay.
You know, I'm like 2 in. I got a whole slide. See how small this text is?
I have no further questions.
I'm going to get there. Trust me. Would you like me to reorder the slide?
No, I'm good.
Okay. So it would be best if you took cash out 6 to 12 months ahead of your exchange. Does that satisfy your question?
So how long is it
sir?
again?
6 to 12 months simultaneously. Yes. Much like your definition. So a lot of people will actually look at this and go, well, it doesn't even need to be that far in advance. And I'm going to caution you that that may not be your best option. 6 to 12 months and then you 1031, that seems reasonable, right? In fact, it could be, hey, I need cash. I'm going to take cash out. And then after you took cash out, you're like, you know what? I'm actually going to sell the property because summer came and my buddy sold a property that's right next door and he got way more than I thought. So I'm going to 1031 now. That's a legitimate reason for doing a cash out refi and then doing a 1031 fairly close together. Again, I would document that.
There's another reason. Any lenders in the room? Any mortgage brokers? So when you make a loan as a mortgage broker, my understanding is that the loan needs to last for a certain amount of time. Otherwise, there's like this really weird clawback or something going on.
The lender gets penalized.
Right, the lender gets penalized, and they don't like it when you do that. So that's probably another reason why you shouldn't do that.
Yeah. So some people actually say it's okay to actually do a cash out refi as long as the property is not listed yet. I would not go that far. I would try and make sure it's at least 6 months before you're going to 1031. However, if you looked, hey, in order to sell this property, I need to get cash out because I need to replace the roof, that is probably a legitimate reason. But again, I would document it. I'm going to pull cash out because I need to fix the roof in order to sell my property. So if I can't sell the property, I can't 1031 it. That's probably a legitimate reason. You would have a good case. In any case, doing a cash out refi of the property to be relinquished too close is risky. So again, consult your expert, but don't get too close. However, with the 1031 exchange completed, I've sold this property, I didn't cash out refi, I've purchased the new property. Is it okay to take cash out now? Yes, no, how many people think that's totally safe? You complete your 1031 and the next day you're like, I'm cashing out.
Exactly 11 people raise their hand.
I saw like 1. Yeah. So while some will tell you, again, wait 6 to 12 months, this is the same crowd as you can imagine, right? There are a lot of sources here that actually say immediate is acceptable. And the reason behind that is you now own a new property. You taking a cash out refinance still leaves you with a loan that you need to pay, and it doesn't give you any competitive advantage versus somebody who didn't just do a 1031 and took the same cash out refi, right? There's nothing there that's going to change it. And that's what I just said. Any questions on cash out refis? Super important. If you're going to sell a property, the relinquished property, 6 to 12 months is probably a good guideline. James is sprinting.
So if I were to sell my rental property for $300,000, let's say, and I'm buying another one via 1031 for $100, let's say.
$100?
Or maybe $150. Can I keep
150,000?
150,000. Sorry,
Yeah.
thank you. So can I keep the profit of selling it and then pay tax out of
So
it?
I have a whole bunch of slides on that.
Okay.
Hang on for that because that's super important to understand how that all works. So we're totally going to cover that in like maybe a couple slides.
That's shoes, right?
What?
Shoes, isn't that what that's called?
Man, Royce, can you punch James? So potential issues. If you take control of your proceeds before the exchange is complete, you're done. The exchange is off, right? You can never, ever touch the funds. You sell the property, the qualified intermediary gets the funds, and they hold them, and then they give them to you at closing to buy the new property. You cannot touch those funds. All your gain would be immediately taxable. Like I said, use a QI, and you cannot act as your own exchange facilitator, obviously. Nor can your real estate agent, broker, investment banker, or broker, any of these people up here, or anyone that has worked for them in the previous 2 years. So it could be a long list. And if you're doing business and your transaction involves a related party, or someone that you know very well, and it's not necessarily an arm's length transaction, like if I was going to sell a house to James, like we would want to consult a professional on that to make sure it was a legitimate transaction. And that doesn't just occur here, that occurs in real estate in general. All right, back to the delayed exchange. Everyone remember what the delayed exchange is? Perfect, I'm going to tell you again just to make sure. Delayed exchange, I sell this property, qualified intermediary holds the funds, I find a new property that I want to buy, and they help me buy it at the closing table. Right? Makes sense? There's a delay in there. They don't have to happen on the same day. I don't have to sell it and buy it at the same closing table. And this is the most common one. So timing matters. Why does timing matter? Who knows what the 45-day rule is? It's a bunch of crap. No, I'm just kidding. It's a really tight timeline. Bob, what is the 45-day rule?
You have to identify the replacement property within 45 days after the sale of the first property, which is really brutal if you're buying 3.
Yes. Yes. So you must identify your potential replacement properties within 45 days of the sale date of your relinquished property. 45 days, you're like, it's plenty of time. It is not. It goes really, really fast. This document must be in writing, signed, and delivered to your exchange facilitator. And I'm going to tell you what needs to go on that. Replacement properties must be clearly described, legal description, address, something like that. We have a question right here.
So if you identify some properties, let's say you sell one, you're going to buy 2, you identify those properties, something changes, is there any wiggle room in this at all?
Please hold for the next slide. This is that thing where I tell you about this and you're like, what happens if this happens? There's no order I can put this in. So the 180-day rule, the replacement property, right? Basically that whole transaction needs to be wrapped up within 180 days. So I'm going to sell this. I sold it. I've got 45 days to go. What am I going to buy? Write it down, deliver it to my exchange facilitator, and then with 180 days, I have to be done. Period. There's no wiggle room. The replacement property must be one of the properties that you identified with the 45-day rule. This is where things get sticky and kind of suck, especially in really tight markets where if you fall out of contract on one property and it wasn't one of your identified ones, what do you do now? You're screwed. You're not doing 1031 anymore.
Yeah, and imagine for a second you're buying a property and you go to do the inspection, you find something on inspection that you didn't know about, and now all of a sudden you have to terminate that contract or go ahead with the property that you no longer want. It gets really weird.
Yep. So neither of these rules care if this falls on a weekend or a holiday. So if you're like, I'm closing on the 180th day and it turns out that's July 4th, you're not closing. So count your days out and actually make sure. And this is different than like the Colorado real estate contract because there's a spot where you can check, do we count, holidays or not, and weekends. So be very careful and actually know where your days land. Things to consider in our market. This was reordered from the last time because someone said, you should have put that slide here. So I put it here. So hopefully it makes sense. Our market, is it like really slow right now? Easy to buy houses cheaply, get a discount? James is saying yes. Perfect. No, it's not. It's really hard, right? There's not a lot of stuff on the market, especially in a reasonable price point. So if you list your property that you want to sell at a reasonable price, chances are high it's going to sell. It's probably going to sell pretty quickly. When that happens, stuff gets triggered. Your 45-day countdown begins. So assuming it takes 45 days to close on the property that you're selling, you have 90 days from the day you go under contract on that property to sell, right? 45 days till it closes and another 45 days to identify your properties. That's 90 days, 3 months, no problem, right? How many of you have been looking for a property for more than 3 months and haven't bought one? Yeah, like everyone's hand in the room should probably be up, right? Like it's hard to find a property. You can look for 6 months and maybe find one and you're like, okay. And then one day, 3 pop up and you're like, oh, I want to buy all 3 of those. But it may not happen in your 90-day window. This goes really, really fast. I think the last 1031 I did, my identification letter got submitted on the 45th day. And it was skin of, just by the skin of my teeth. Remember, if you don't buy one or enough of the properties you identify, the 1031 doesn't take place and you don't get to defer your taxes. Finding a property, getting it under contract, and then removing all the contingencies like James mentions. You go and you have an inspection done, you're like, oh crap, I don't want to buy this property because the foundation is not stable. So you drop out of contract, that's tough. As the purchase price gets higher, right, part of the goal of being able to 1031 is I buy one single family house, I let it grow, the equity builds, I take the equity out of that, and maybe I buy a duplex. And I let that grow, and then maybe I buy a 4-plex, and then maybe an 8-plex, and then maybe a 20-plex, right? And you're basically stepping up in size or stepping up in number of properties. But if you're selling an 8-plex and you put it on the market, and you're like, well, I need to buy a $2.5 million building, how many of those came up like last year? Like 3.
In a 45-day period.
Yeah, it's 0, like almost every time. It's really hard to find that. And if you do find it, it might actually be way overpriced anyway.
And not a deal.
And not a deal. So even closing in that 180-day window can be difficult in some cases. So just be really, really aware that these timelines are like, they seem like, oh, that's pretty good. But then when you're living them, you're like, this sucks. Like 45 days is not long at all. Identifying your replacement property. You got a question?
No, I was just going to make a comment. So we're in a crazy market right now, but the opposite happens when the market changes, where you may have lots of opportunities to buy in, but it may be really hard for you to sell the thing you're trying to 1031 out of.
Yep. So how do we identify? There are 3 rules that we can use. Anybody know any of them?
Rule 1.
Perfect. James says rule 1. Yeah, I took the 1 out. So the first rule is the 3 property rule. You can identify up to 3 properties. And this is very common and very easy. I'm selling my single family home and I want to buy one of these 3 other houses. And that's all you do. You say, here's the 3 houses I want to buy, and you're going to purchase at least one. You could buy 2 of them, you could buy all 3 of them, but you're going to buy at least one. Royce, we got a question in the back. Get off your phone. Hang on, wait for the mic.
This might be a jump ahead question, but for example, if I want to buy 4 properties with the money I have, can I identify 4 because it's up to 3?
Yep.
Is that a limit?
Yes. Hold for 10 seconds.
Okay.
So, like I said, in this case, pick 3 possible and buy 1, 2, or 3 of them. If you buy 0, the 1031 doesn't occur. This is probably the most common because most people are selling one property and they're either stepping up to one larger property or they're selling one property and they're buying 2 of whatever it was they had. That's the most common kind of 1031. However, the next rule, just for you, is the 200% rule. Identify as many properties as you would like, as long as the aggregate value doesn't exceed 200% of the thing you're selling. So you're selling something for 500, identify as many as you want up to $1 million, and then buy as many of those as you would like.
So my scenario was that if I have 200,000, I want to buy 4 $50,000 each properties.
Okay.
Would that fit in that?
Yep.
Okay.
So you say, I'm going to identify property 1, 2, 3, and 4, and the aggregate value. So in that case, you could actually identify 8,
Fine.
right? And then pick your best 4.
That's great.
Which is probably a better thing because then you have choices.
And the follow-up question was, within the 45 days, can I change those identified properties?
Once you've submitted the doc, no. Which is why, in my experience, I would like to either wait until the end of the 45-day period to submit it, or in my case, I just put something under contract literally on day 45. And that was rough. Bob's got a question.
Please sit down, Royce.
Take his phone. He's like texting me or something.
Is he texting?
Contracts to be signed.
Oh.
Yeah, let him play with it.
No, I'm pretty sure you can change your selections before the 45 days closes.
Yeah, I just never submit it until
because
the
maybe
45th
one of
day.
them already just got sold last week or something, so you
Yes.
change your mind about that one.
Yeah, that would make sense. But I've never submitted mine. In the 1031s I've done, I submitted mine on day 44 or 45, and then in one case, my property actually closed inside that 45-day window, the replacement property, and so they didn't even need the 45-day document because they were like, well, we know what you bought, like you've already closed. So, was there another question? James is ready to run. So again, the 200% rule, right? You could pick 6 properties and you could buy 1 of them, 2 of them, 3 of them, 4 of them, 5 of them, or 6 of them. So if you're trying to take $200,000 and turn it into 4 houses, this is the rule for you. This is also pretty common with real estate investors. And then our last rule, which in my opinion is the most useless rule for real estate investors, which is identify as many properties as you would like exceeding 200% of the aggregate value, right? So this is 200% and below, this is above 200%, and buy 95% of them, which is like, hey, I picked 20, I gotta buy 19. Not really useful for me, right? So that is not the greatest, but that's the rule. And like I said, it's hard to use that in the actual real world. Any questions on those 3 rules? Perfect. So an example without a 1031 exchange. This is where we're going to get into dollars so that you can actually see the difference. So we're going to assume in 2013 we bought a property here in Fort Collins, 3-bed, 2-bath home for $250,000, which was real. You put 20% down, so it was $50,000. We're going to assume it's 15% land value just because we're going to have to do depreciation calculation later, so I'm trying to be complete. And in 2019, you decide, I'm going to sell the property for $375,000. You've owned it for exactly 6 years. That's what we're going to call it. Approximate proceeds, right? 375 minus 250, $125,000 of profit, right? That's your gain just on the property. And then you put 50K down. So total, you have $175K coming out of that transaction. Wave your hands, there's no closing costs. We're just ignoring that for right now, right?
What about debt pay down?
Sure. 6 years of debt pay down. Yep, agreed. Again, we're waving our hands and focusing on the big numbers.
Yeah, it looks like 175 to me.
Yeah, thank you. It was an interest-only loan, James.
Okay, that sounds good.
Yeah. So if you don't defer your taxes and you don't do a 1031 exchange, how much do you think you're going to pay in taxes on this transaction? 30%? Anyone else? I heard depends on your bracket. James, I heard 20.
Is your long-term cap gains rate, which is probably 15% for this person.
Okay, is that it?
Well, if you have depreciation recapture too, but we're not talking about that yet, are we? We're just talking about on the gain.
Well, how much are you going to pay? I mean, you're going to have some taxes to pay.
Yeah, so you'll pay 25% of the depreciation recapture as well.
Yeah, minimum, right? So typically, long-term cap gains, because we held it over a year, 0, 15, or 20%, right? It's not the next bullet. And then you've got depreciation recapture. So you've been depreciating the property. And by the way, just in case you're like, hey, I'm just not going to depreciate my property, I'm not going to claim it, and then I won't have to pay the recapture, guess what? You're screwing yourself twice. You're still paying the recapture even though you didn't take the benefit. So don't do that, because everyone that talks about recapture is like, I'm just not going to pay it to begin with. Bad idea. So 25% minimum, this is going to depend on your tax bracket, but it's 25% minimum for the recapture. And we taught a class that was in the arguably the best class, I think part 3. If you want to go, I don't know if you can listen to that one anymore, but it basically shows that if you're in a really low tax bracket when you're depreciating, you might be getting hurt because you're not getting enough benefit from the depreciation to actually account for the recapture later. James.
I was gonna question the minimum part of it, but also say that, yeah, it's a tax on the poor. Yeah. 25% depreciation recapture.
Yeah. I mean, I guess you own real estate. Can't be that poor, hopefully.
When your income is lower, you end up getting taxed at a much higher rate.
So the recapture is going to match your ordinary income tax bracket if it's above 25. So the 15% basically applies if you're a single filer for your income taxes. If you make between $39,376 and $434,000, which is the majority of people, right, that are probably investing in real estate, then your long-term cap gains is 15%. So we're just going to use 15%. James, you don't like that?
I didn't realize recapture went up to ordinary income tax bracket if it was over 25.
Oh, we have a CPA in the room.
I'm pretty sure it is capped at 25%.
I thought so too.
I think the minimum is 25 and it goes up.
There's a zero.
Yeah.
I've seen it as a fixed minimum on calculators that I looked at.
Yeah, but I've seen an example where they had it at 28, so I'm pretty sure it goes up. I could be wrong. Like I said, not a CPA, so there you go. If you have net investment income, you may have a 3.8% penalty on that tax as well. We're not going to account for that here tonight. One of the cool things is if you have passive activity losses from previous years that are rolling over and you're like, I don't know what to do with them, this is a benefit. They can help offset that depreciation recapture. So You know, if you have like $40,000 of previous stuff that just keeps rolling over every year, you can finally use it.
But no one has that, right?
Lots of people have that. So, cap gains plus recapture, right? 125,000, that's our long-term capital gain times 15%, plus what we depreciated, which is about 46.3 times 25%. We're paying about $30,000 in tax. So that's what happens if you don't do a 1031. So instead of having 175 to invest, you're going to have about 145. So you're lowering your big principal chunk that you have to invest. It'd be like if I said, hey, you invested $100,000 in the stock market, and then the stock market went down 20%, and you cashed out. That sucks because it's like that is your first ball of principal. And so it takes time to make it back to the 100,000. So this is a benefit to doing that. James.
I was just going to say that's 175 is including your down payment back, so really it's less than that on the 125 profit. The 175 proceeds is actually 125 profit plus the 50K down back. So it's kind of an interesting way to look at that.
Yes. But that's, what are you saying? I'm not
I'm
sure
saying
following
really
what you're
it's
saying.
not 144. You really have like 94 of the 125 that you initially made in profit. So your taxes
Oh,
really.
yes. Yes. Agreed. That's somebody's car alarm? If your car alarm is going off, it's James. Does it sound like your car?
I don't know. It might be.
Nice. So let's take that same example and actually, what does it look like with the 1031 exchange? So same thing, buy the property, sell the property, same 175K. Using a 1031, you get to defer this. So here's where the fun begins. We're going to take that money and we're going to go buy another property worth at least $375,000. Right? In order to 1031 without having any detriment or losing any of the gain and not being able to defer all of your taxes, you need to purchase something that's at least of equal value. So if you sold something at 375, you need to buy something at 375. You take that 175,000 and you put it down, what's going to happen? Is that going to be a nice property that's cash flowing decently? Probably, right? So that's one better, right? And you might be able to update your inventory, right? Instead of having that house that you first bought that was built in 1980, now you bought a brand new home, and so you've updated your inventory. It's portfolio optimization in some cases. You now don't have maybe as much CapEx coming. Does that make sense?
That's a big deal, actually, being able to get rid of CapEx.
It is. Or you could take this and go buy a fourplex worth $700,000, put that 175K down, which is 25% of that, and be super happy there. Taxes are then obviously deferred until you sell the fourplex. Or go buy $1 million property, right? And you can bring another, whatever amount of money you need to bring. It's fine for you to bring extra money to the table. It's not okay for you to take money off unless you like paying taxes. So, lots of choices. Now we're going to talk about boot.
Shoes.
No, shoe. It's just shoe. It's just boot. So, boot is an old English term that means something given in addition to, which is basically, you'll understand it here in a second. Same exact example. Buy the property. This time I'm telling you, hey, guess what? The remaining loan balance is $185,000. So there was $15K of loan paid on.
There you go.
Yeah, I needed it for this example. Duly noted, when I listen to this recording and we teach this again in a year, I'll update it.
Thank you.
So, same approximate proceeds. With a 1031 exchange, you decide, I'm going to go buy a property for $400,000, but you're only going to put $75,000 down using the 1031 exchange. So you're going to get $100,000 in cash. Sweet. Guess what? Are you paying tax on that? Yeah, you're paying tax on that. And what's crazy is you need to remember that your down payment actually gets used first here, because there's no chance in hell that the IRS is going to say, yeah, let's defer the gains you had and you can just have your down payment back first. That's not happening. The IRS wants their money, right? Does that make sense? So you have to use your down payment first. This cash that you're getting back is called cash boot. Cash shoe, if you're James. It's not a cash cow property, especially if you're only putting $75,000 down, right? This is fine, but you're going to pay tax on that boot. Or another example, and this is where things get slightly complicated. You buy a property for $300,000, right? So we didn't meet the criteria. We're buying a property that's worth less, but we put the whole amount down, but we only take a loan of $125,000. There's now what's called mortgage boot. Because you didn't take the same loan on the property that you acquired or greater, and you got a benefit from that, you have to pay tax on the mortgage boot. So now James has a pair of shoes. He's got a cash boot and he's got a mortgage boot. What he really has is Crocs that he wears in the snow. If you've never seen a house with him in the winter, you need to. Just wait for a day when it snows and he shows up in Crocs and socks. The best one was your like socks like walking across the floor leaving like wet sock marks.
Because it was wet snow.
Yeah? Really? The snow was wet?
I mean, sometimes you're not like 6 inches deep in the snow and it's not going through the holes and stuff.
So in this particular case, So in this particular case, the difference in the mortgages is $60,000 and you're going to have to pay tax on that difference. So it's strongly advised when you're 1031ing, if you want to get the benefit of what 1031s are designed to do for you, is to always trade even or up in value. Right? Very straightforward. To avoid mortgage boot, get a new mortgage that's the same value or greater. Contribute cash to the purchase in the amount of the previous paid off mortgage. So if you would have said, hey, I'm actually going to contribute $60,000 from my pocket into this, you would not have mortgage boot. Because you basically don't get the benefit that you were going to get. It offsets. This is known as trading down. And so trading down is not necessarily a bad thing to do. If you're like, you know what, I am tired of acquiring more properties, I just want things to be more paid off and have more cash flow, then trading down might be for you. But make sure to buy a replacement property that costs more than your adjusted basis in your old property so that you don't lose all of your 1031 benefit. Your CPA and 1031 professional can help you figure out what your adjusted basis is. That's a whole class all by itself.
Yeah, probably.
Figuring out what your basis is. Any questions on boot or boots? Bob has boots questions.
I'd just like to have you kind of walk through the long-term strategy if, okay, you bought a house a long time ago.
Okay.
And you had a mortgage of, let's just say $100,000.
Okay.
And now, you know, you've been paying this down and, you know, maybe you owe $80,000 on it now.
Okay.
And
how much is the house worth?
Oh, I don't know, $200,000.
Okay.
Let's just say.
Okay, and now the loan's $80K.
Yeah, you got this idea that I don't want to be owing these bank people. I don't like banks, maybe.
Sure.
So how do you ever get rid of this? Because you're saying here to get your maximum cash benefit, you have, maximum tax benefit, you have to be sure you have debt at least equal to your previous debt.
Correct.
On the new property.
Or
right?
contribute cash. So you could buy another $200,000 house,
Yeah.
contribute $80,000 into the deal, and roll the rest from your 1031, and you'd be okay. Or you could have this loan slowly pay off, right? Or you could jam all your cash flow back in and pay the loan off, and then 1031 into a $200,000 house, and it would not have a loan.
Yeah.
Right? Paying your loan down and like getting rid of your loan, like you can trade down to do it, but you're probably going to end up paying some mortgage boot. I mean, the other thing, yeah, I'm not going to say what I was going to say because it will derail us for like 20 minutes. So.
Oh, wait, another question. Oh, look, he's wearing Crocs too. You can't make fun of me.
It's not snowing.
All winter long.
It's dry snow outside right now. It's not wet snow.
So in the example you had on the whiteboard there, though, he had to take on a loan of $80,000 to not.
Or more when in the replacement property, yes.
Or more.
Yep.
So, but he could, it doesn't have to be the same percentage. Like he could do a loan with 50% down or something like that. It's not as a percentage, it's just as the amount.
Dollar amount.
And it's
Yep.
the dollar amount, not when you started with the property, but when you sold it, right?
It is the dollar amount of which property?
The one you're selling. So it's the debt.
It's that.
It's the remaining loan balance, not the original loan.
Yes, it's not the starting. It's what you have loaned currently on the building.
Okay, and there's no percentage rule there, so you could take your $80,000 and do any kind of LTV.
Yeah, so I mean, you could essentially say, I'm going to go buy a larger property, but I'm still only going to have an $80,000 loan, and I'm going to contribute more cash, and that's totally fine. Yeah. All right. A note on choosing your exchange provider really wisely. James likes this slide a lot.
I do.
And you'll notice the text is really small. So small that I can barely actually see it, even though I'm right here. So qualified intermediaries are not generally licensed, regulated, or insured. So think about that for a minute. You're going to let a QI take $200,000 of your funds, hang on to it for a while, and then show up at closing, hopefully with your money. You might want to interview them before you actually give them your money. So they can choose to be regulated. So they can go and they can say, hey, we'd like to be regulated. We're going to get licensed. We're going to get insured. They can choose to do that, but most are not. And they're likely holding a lot of your money. So you want to be super careful. During the downturn, a lot of them went bankrupt. Where's your money? Poof. Right? Gone. That's really sucky. You worked really hard. You've been trading up in your 1031s for 20 years, and then downturn happens and they just go bankrupt. So ask your intermediary, hey, what's your plan if you have to file bankruptcy? See how they respond. Do they keep funds in a separate bank account? Right? Like a property manager is required, if you're not managing your own properties, if you're a licensed agent, you have to keep security deposits in a separate account. So are they keeping your funds in a separate account, or are they using them to run their business? Right? Because you can imagine a 1031 that has a lot of business, has a lot of money coming in and a lot of money going out, but there's a period of time where there's just a bunch of money, right? And more keeps coming in and more keeps going out. Well, that sounds a lot like a Ponzi scheme waiting to happen. So be careful. They are allowed to do whatever they want with the funds. Yeah, that's what you should be thinking. It's like, what? Shit, how is that possible? Like, no. Yeah.
Yes,
So
you can. It's unlicensed and unregulated.
You can go
be a
start your
QI.
own exchange facilitator, and you too can go to prison later. Do not do this. So the company should be bonded with a fidelity bond and probably have a per occurrence insurance policy. Those are questions you should ask. If your facilitator doesn't have your money, your 1031 exchange is not going to be extended. It's not their problem.
Taxes will be due.
Yeah, taxes will be due on money you don't even have. Other things to ask, even smaller text, right? Is the intermediary subject to oversight and regulation? And if so, by who? Right? What regulatory or government agency are you licensed, regulated, and audited by? Having someone audit an exchange facilitator seems like an amazing idea, right? At least somebody's holding them accountable every once in a while. Does the intermediary have tax professionals or certified exchange specialists capable of assisting you on tax issues? They should. They should know what they're doing. Is the intermediary member that's a hard one to say. Is the intermediary a member of the Federation of Exchange Accommodators, which is a professional organization that basically expects its members to perform at the highest level? It's like being a realtor, right? We expect you to perform at the highest level possible, all the time. No excuses. Does the intermediary have experience and a verifiable reputation? Don't just search online for 1031 exchange and pick the first one. Like, it might just be, Carol here who started her own company and is waiting to take your money.
Hey, she has a 1 5-star review on Yelp. She's good to go.
Yeah. Yep. Yeah.
That's right, your friend put up.
Are they willing to help you, right? These are just questions. So you can come back and reference these, and you can go search on questions you might want to ask a QI. There's a bunch of them online too, right? Do they have an adopted investment policy that requires safe, secure, and prudent investments? They get to do with your money what they want. You might want to ask, what the hell are you going to do with it? Because that's a lot of money they're handling. And is it easy for them to make it liquid back to you?
And this is where my habit of watching really crappy, sleazy television benefits you. Because I saw an episode of American Greed once where they had this qualified intermediary that was actually scamming people. They were taking the money and spending it, and their business model was to acquire other qualified intermediaries, because you don't pay based on the money that they have, you based on how profitable they are. So they would go buy an intermediary for $100,000, and they would take over $3 million worth of other people's money that they had being held up in the QI, and then they would spend that money to go acquire some other people, but they'd spend part of it. And so it was this like major Ponzi scheme scam thing where they were acquiring all these other ones because it's like the Wild Wild West. So be careful.
Question back there.
Oh, question.
NCREG is sponsored by American Greed now, apparently.
We are not.
Oh, okay.
Are there any major firms that provide these kind of services,
Yes.
or is it all little onesie twosie guys?
Nope. There are plenty of firms like the one that I have used it's an extension of First Bank. It's basically 1031 Corp. It's like 1031 Exchange. I don't know what the website is, but like First Bank has kind of their own separate company that does 1031s.
And a lot of title companies have their own sister arms where they do 1031 exchanges,
Yep.
and I would trust them probably more than mom and pop 1031 exchange companies.
Yeah, I mean, find a bank you have a relationship with and then ask them, hey, if I want to do a 1031, or a title company, if I want to do a 1031, who do you recommend? But then go look them up, call them, and ask some of these questions. Find out, hey, are you ever audited? What do you do with the money? Do you have an investment policy? I'd like to see it. Like, tell me what you're going to do with my $100,000 so that I can make sure I can close on my replacement property. So, what do you need to put in the contract? When I listened to this recording last year, you got this question wrong. So we'll see if you can get this question right. One of these examples is what James uses in his contract. Will he know what it is?
No, I'm not going to get this right.
So I'm going to read these just so you can understand, right? So no assignability. In section 2.2 of the contract, it basically says contract is not assignable, right? This would be an additional provision that says, notwithstanding that section or anything contained in this contract to the contrary, each party must cooperate basically to have a 1031 undertaken by the other party that involves the property, including consenting to and acknowledging assignments of this contract, because the contract is going to be assigned, to a QI, so long as such cooperation is not to the detriment of the cooperating party. Basically, hey, I'm doing a 1031, I'm buying a property from you, and you're going to cooperate as long as it's not to your detriment. You good with that? Everyone says yes. That's one example. Here's another one, just longer, right? Seller and or buyer. So anyone involved, right? Because you might be having a 1031 going from both parties, right? May at exchanger's option consummate, which is the weirdest word to use in a contract to me, like the disposition of the property through a like-kind exchange pursuant to 1031 of the IRC. If exchanger requests, the other party, blah, 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 shall cooperate with exchanger by executing additional documents, right? The exchanger shall reimburse the accommodating party for any additional attorney's fees not to exceed $250, and the accommodating party need not assume any additional liabilities. So again, hey, we're going to reimburse you up to $250. You plan to just sign the documents that we present so that we can basically consummate our 1031 exchange. Pretty easy. James, is that yours?
I don't think so. It's not, right?
Was the first one yours?
Who knows?
Yeah.
I mean,
at least now he's on the I don't know.
Yeah.
In the previous class, he's like, that's not mine, and it was. So I was like,
There you go.
That's pretty good. So very similar, right? Like-kind exchange, buyer and seller. Buyer and or seller shall have the right at their option to basically use a 1031 exchange per the IRC code of 1986, as may be amended from time to time. Getting really specific here, right? Each party agrees to cooperate with the other in order to do the 1031. Whatever means are necessary. Each party bears their additional transaction costs and all reasonable expenses. It cannot cause an extension of the closing date. So any of these three are probably good. If you work with James and you've used the contract, this is his.
so we got ours from an attorney, so it's
Yep.
not like I made this up, just to be clear.
Yep. And I've seen all sorts of ones. And I asked Tammy to send me it, and it was already in here. But she sent me another one that basically was like from a 1031 company. And it basically was like, it said like, hey, everyone will cooperate if we want to do a 1031 exchange. It was like really like lackadaisically worded. It was quite interesting. So those are three examples. You'll want to put that in your contract if you're thinking about 1031ing one way or another. Bob.
And you don't need to have like your own verbiage. You don't need to write that down.
Correct.
I don't think I liked your $250 thing. That's just like saying, hey, I'm buying your property, and oh yeah, by the way, I'm doing a 1031, which isn't going to bother you a bit, but you can hold me up and make me pay an extra $250 so you can waste it on some attorney to say, oh yeah, it's okay for you to be selling to a
Now I have to
1031
reimburse you for the $250. That's what it's saying. I just can't. I'm not going to reimburse you more than $250.
Yeah, but I don't want to reimburse the seller of a property if I'm the buyer just because I'm
No, if
doing
it's
a
your
1031.
expense. If you cause an expense to me in the transaction, so I'm the
not going
seller.
to cause you any expense,
Right.
but this is an invitation for you to demand the $250.
I don't think so.
Well, how would I cause the seller an expense just because I'm doing a 1031?
You won't. But if you did cause me an expense, that's why it's in there, right? Like if there was, if you had a document that was drawn up and your contract was drawn up by an attorney, and suddenly you're like, I need to do a 1031, and they had to amend the contract, the attorney may actually have to have it reviewed, right? You may say, hey, I'm going to have my attorney review this, and I'm like, that's fine. Here's $250. It
I
doesn't
got a
happen.
cheaper attorney.
Use a different clause. Cheaper attorneys are not good.
Sometimes they won't accept the offer unless you say, hey, listen, you'll pay to have my attorney review it so that I make sure I'm not in trouble, because they don't know.
Yeah.
Oh, what was the question?
Are these clauses available in the contract under additional provisions?
Nope. These are clauses that you would need to have your attorney or realtor add in.
Yeah, and most of the time, if you're going to go hire a 1031 company, they'll tell you what to add in the contract if they're going to be working with you.
Yeah,
so you
so
get this from your 1031 company.
Again, I would not use that clause. I would use the clause from your expert realtor who has hired an attorney to write that clause for you.
You could do that too.
Yep. So let's talk about taxes. Your QI is going to provide some exchange documents after it's complete, right? This contains the assignment because your contract was assigned. It's going to contain the exchange agreement, which details, hey, this is the property I was selling, this is the property I was buying. It's going to contain the deeds, the settlement statements, and other pertinent docs. So my 1031 company, basically, I already had all these docs, but they sent me a package at the end of the year and said, here's all the stuff you're going to need to give your CPA. I was like, excellent. Thank you for doing that. You're going to have to file Form 8824 with your tax return, which details the exchange to the IRS. The IRS wants to know about this exchange to make sure that it followed the rules, because otherwise they want you to pay tax. A few interesting tax points. I'm like, there are none. So if you bought 2 replacement properties, which is common, right? Or 3 if you're going from California to Texas, like Bob, right? If you sold one, bought 2 in its place, and then you decided, hey, I'm going to sell one later without 1031ing that, have you done this?
No, we 1031 2 out of 3 already.
Perfect. So you're going the other way? I don't know. We can talk about it later. So if you bought 2, sold 1 later, the basis for that property is based on a prorate of the fair market value at the time of purchase. So they're just going to prorate whatever you did, and that's the tax you're going to have to pay on the one you sold.
On the value, not necessarily the loan to value.
Correct. There's currently 2 ways to handle this with respect to CapEx and depreciation. Please go consult your CPA. We're not going to dig too far into this. But basically, you can use the carryover basis from the old property and continue to depreciate it over its remaining life, and then add a new asset for any boot paid. This increase in basis is treated as if it were newly purchased property with a new useful life, 27.5 years. Or you can treat the entire purchase as a new asset and depreciate it over 27.5 years. In many cases, the annual depreciation is similar to what it would be without making this election, but the previous depreciation recapture is eliminated. This may have changed. I'm not sure. The subsequent sale of the property would result in, again, our tax brackets for cap gains versus the minimum 25% for the recapture. So there's some benefit to you here because you're going to pay this instead of this. If you want to go look that up, it is Regulation Section 1.168, subsection I-6. It's a long document.
Go talk to a CPA.
Yes, please. Closing costs. Not all closing costs are created equal, especially in 1031s. So some, if you pay it with your 1031 exchange funds, will become taxable boot. So you need to be careful on your transactions. Most title companies seem to be aware of this. Your 1031 company should definitely be aware of it, but make a note to have this conversation. Prorated rent, damaged deposits, utilities, points, homeowners' dues, and repairs to the property, all of those need to be handled outside of closing. So what does that mean? When that relinquished property sells, you're going to need to actually write checks outside of closing. You're going to want to get a receipt and say, hey, here's the prorated rent, here's the damaged deposits, and you don't want to do that with your 1031 funds. Make sense? Talk to your 1031 professional. How many of you have closed on a property that you sold and they like estimate what your utility bill is going to be and it's like $800 and you're like, the bill's like $70 a month, and so they withhold that and then they send you a refund check from the utility company and you get it and you're like, Well, that sucks. If you get that check, don't cash it. If you're doing a 1031, send it to your QI. It's part of your 1031 exchange.
Is that like refund boot?
Yeah. I don't have another foot for that boot. I'm out of boots. So how much does a 1031 cost? Typical cost for delayed exchange. This is updated. It used to be $500. It's now $700. These are the prices at 1031 Corp with First Bank. And then it's $500 for related. So if I sell one property for $700, I have to pay $700 when I sell it. And then if I buy 3 properties related to that transaction, it's $500 for each one of those properties. So if I bought one, if I sold one and bought 3, it's $2,200. Not too bad. Bob says, I don't like it.
Well, you can get a really inexpensive mom and pop to do it for like $200, right?
I don't think so. Yeah.
But they may not be in business.
I mean, Bob had a cheaper guy, but he was lucky. He was on the lucky side of the Ponzi scheme.
That's right.
So
he was one of the few that got repaid.
Yeah. So if you're foolish like me and you're like, I'm not going to do 1031, and then you're like, oh my gosh, it's like 2 days before closing, I'm totally going to do a 1031, you get to pay $250 extra. It used to be $200. And I tried to convince him, but I talked to you about it last week. And she was like, no. And I was like, fine, right? But if you think about this from our example, if you paid $1,200 to sell one property and buy one property, to save yourself $30,000 that you can continue to invest, tax deferred, that's a pretty easy choice.
It's delaying the $30,000.
It just said tax deferred.
Right, but you said save. It's not really saving. It's just pushing it down the line a little.
Yes, but you are saving from having to spend $30,000 in paying tax.
Today.
Yes. You can just just die.
Maybe.
Yeah. All right, you're gonna delay my class.
Oh, I'm sorry.
Reverse exchanges, that thing where, hey, I bought the new property first, and then I sold some properties, and we did the whole EAT thing, if you remember that from earlier. This is much more expensive. Currently, it's $4,500 at 1031, which makes sense because they're actually setting up an entity and then holding title to the property, right? And then waiting till you sell these and then moving it over. So there's a lot more work involved in that from them. Takes a lot longer. Brendan's not here. This slide is solely for Brendan. So at some point, how many of you have been to asset protection?
I've been to it.
So if you've not been to asset protection, this slide may not make sense. I'm not teaching asset protection tonight. So if this doesn't make sense, fantastic. Just ignore it and move on. So if you're following our typical scheme where you buy a house.
I thought you weren't teaching asset
protection. I'm not. I have to explain this part, right? And the house is titled in a trust, and the trust is the beneficiary, or the LLC is the beneficiary of the trust, and this is a single member, and then you've got a master LLC up here. Very typical asset protection strategy that lots of attorneys will recommend, and we just go into depth in asset protection. Part of the problem is that when you sell a property that you relinquish and buy a replacement property, it has to be the same entity, exactly. So in this case, you're like, I'm selling this house that's titled in the trust, but the one I'm buying, I want this LLC to own it. I don't need the trust to own it. I'm just having the LLC buy it because I'm not buying it and titling it in the trust. My bank wants it titled in the LLC. How do you do that? Here it is. 1234 Main Street Trust. Billy Bob is the trustee of that trust. The beneficiary of the trust, ABC Holdings. Billy Bob is the manager of that single member LLC. The new property is going to be owned by that ABC Holdings LLC. In the assignment documents, this is what you're going to put and on the 1099-S. 1234 Main Street Trust, on behalf of ABC Closing or ABC Holdings LLC, its sole beneficiary by Billy Bob as trustee. And then in the exchange agreement, the flip side of that, ABC Holdings LLC as the sole beneficiary of this by Billy Bob as manager. That will solve your problem. You will only need this when you need it.
Talk to an attorney.
You will not need it tonight.
So let's say you do everything correctly here, and then you decide you want to change something after the deal's already been done. Can you?
Yep. Yeah, I mean, once it's titled in here, you can do what you want with the property just as if you had not 1031 in most cases.
You can change the name of the LLC.
The question was, you could change the name of the LLC
That was
there.
my question too, because
Later.
otherwise you're gonna have to.
Oh,
spell
wait,
the
wait,
address.
wait, microphone.
Yeah.
Well, you're not going to have the wrong address because this is 1234 Main Street Trust, and that trust is gone after you sell the property. You're titling it back in the LLC. Please don't name your, this is asset protection. Please don't name your LLCs the name of your property.
No,
the trusts,
name them all Brian Williams Trust.
please do not do that. That is not funny at all. Oh, man. Oh,
Question.
if you were paying attention, James, instead of making jokes
I
about
know, that's my fault.
trusts and naming.
The 1031 I did last year, single member LLC, I wanted to put it into the name of a different single member LLC. That was okay, as long as it was still a single member LLC with the same single member.
Who is your owner of the single member LLC?
Me.
You were the owner, or it was a master LLC that owned it?
No, just me, just single member LLC.
Yeah, consultant attorney.
Well, the 1031 exchange, so
Yep,
that's what I could
and that's
do.
where that's where that is from as well. It's from 1031, and then it was reviewed by an attorney. So I have pretty high confidence that that's right. But in general, on the documents, like from the IRS perspective, it's the entity that's selling is that, and the entity that's buying. I wonder if they went, hey, it's a single member LLC, and you're the owner. So they went, well, you're still the owner, which seems okay, but it also seems like you just did alter ego violation with asset protection. You just pretended that you were the LLC in order to make that transaction happen. So I would consult an attorney. I wouldn't worry about it, but.
Yeah, definitely talk to an attorney.
My understanding is if the tax number is the same, old name LLC, new name LLC, the tax number, whether it's a tax number or your social single member, it's okay.
Yeah, your EIN was the same?
EIN or...
Yeah, hers was not, yeah.
No, I'm talking about, so my example, the one I read about was the single member, personal social, same for the old one, same for the new one, is okay.
Yeah. I will look it up for next time I teach this class, but great points.
Talk to an attorney.
Yep. All right. Partnerships and 1031 exchanges. So remember when I said, hey, partnership interests don't count? These are some slides about how to actually deal with that, because a lot of people are in partnerships where, hey, you and I partnered on a deal. We've had it for 10 years. You're like, I just want out of this. I'm tired of dealing with you, Brian. Like, just give me my money. James is like, yeah, it's totally how I feel, right? He's like, I just want my money. And I'm like, I just want a 1031. Don't you want a 1031? And this is a great deal. And you're like, nope, I'm out. Well, we can't 1031 as the LLC because he wants to take his money and go, and I'm not the entire LLC. So how would we deal with that? A partnership with two or more partners who wish to wish to sell and go their separate ways. One wants cash, one wants to do a 1031. How do we do it? Very carefully, just like we do everything in class. Very carefully. Prior to the sale, we deed the property to the partners as tenants in common. So if you were here last week for self-directed 401k, we talked about tenants in common, also known as TIC. Basically, we're going to say, hey, it's his name, a 50% undivided interest, and my name, a 50% undivided interest, whatever our partnership was in the LLC. And now we can then sell that property, and he can take his cash, and I can go 1031 exchange. Because I am 1031 exchanging my 50% undivided interest, I'm not a partnership interest anymore. Tenants in common allows you to do some really fun stuff or really crazy stuff, depending on how you're looking at it. Please be very careful with TIC. If you do not understand TIC, especially if you die in Texas, it's really not fun. Trust me. I've died in Texas before. This is known as a drop and swap. Frequently, it's done at the same closing table. So he's like, I want my money. I'm like, I'm 1031, and I know what I'm 1031 into. Boom, we go to closing, and they basically do the drop and swap, right? They tend to recommend that you do the drop, right, which is the transfer into the TIC, 6 to 12 months prior to the swap, but that doesn't always happen. Any questions on that? That's basically how to get out of a partnership and still 1031 so that you can defer your taxes. Pretty nice. Next one, a partnership with 3 or more partners who wish to sell, and some of the partners want to remain in the partnership and do a 1031. So James and Royce and me, we're like, yeah, and Royce is like, screw you guys, right? I'm out. And James and I are like, 1031, right? That's what we're doing. So I guess there's one other person. Where do they go? 3 of us want to go do a 1031. Partnership distributes tenancy in common to the partners who wish to do the split off. Bye-bye, Royce. You've been ticked, right? Then the remaining partners still in the LLC simply do the 1031 exchange because it's whatever LLC name it was, selling the property. Royce gets his money because he's a part of the tick, and we 1031 into a new property. We got questions back here.
Wait, microphone. I'm running.
So in this particular example, are there 4 people in the tick or 2, meaning the guy who wants out and the partnership is the other tenant in common?
The one who wants cash gets ticked.
Okay.
Yep.
But then the rest of them stay as a
In
single
the LLC,
entity.
yep. That way the LLC can just transfer and buy whatever replacement property they want. Yep. Yeah, I should have used an example with 4 people. Next one. You or your entity sells a property and you want to partner with others that weren't in the original selling entity. So how do we do that? Example, Billy Bob sells a property and wants to partner with Sally Sue and Jazzy Jeff. I mean, who doesn't want to partner with Jazzy Jeff, right? Billy Bob would take title in the replacement property as tenants in common with the others. So we're just using tick in kind of the reverse way that we did in the first 2 examples. Contract and title specify the percentage of ownership, just as they would in any tick. And a separate agreement, this is pretty key. So now we are in an agreement where we bought a new property and we're still in a tick. And in that case, there's not an operating agreement because we're not an LLC. So what you want to make sure you do is that you actually take everything you would normally put into an operating agreement that defines how you're going to work together, how you're going to make decisions, who gets to vote, all that stuff, and you want to actually detail that out. Because otherwise, how do you know how you're running the partnership?
The question was?
The question was, aren't you going to just quit claim it into an LLC? You would probably need to talk to an attorney because if you 1031 into that, I'm not sure how they're going to see that and what they're going to think. I don't know the answer. Partnership interests don't qualify for 1031 exchanges, which is why we just talked about all 3 of those slides. Royce has a question, and the mic already.
I'm ready to go. So there are additional details that need to go into dissolving or adjusting that partnership based on your operating agreement, right? For those that had an LLC.
Say that again.
So like in the case where you said you had an LLC with multiple partners, right?
Yep.
One of the ways you get one of the partners off the property is to do the tenant in common. But you still have to deal with the details of basically getting them out of the LLC, right? That's some additional extra.
Well, when you tick it out, they're basically taking an undivided portion, their portion of the interest in that property. And so you should have a document, unless you're doing it at the closing table, which is probably why it happens at the closing table, so that you don't have to go draft all this other document stuff. So, can I owner occupy after 1031 to avoid taxes? So for those of you that are like, hey, I would like to owner occupy to avoid the taxes, this slide is for you. Here's our scenario. Sell a rental property and buy a new rental. Rent it for 2 years. Pretty easy. Then move back in for 3 years. You're like, yeah, I'm moving back in. Can I then sell as an owner occupant? And if below the IRS limit for the 250K or 500K, so that's, you get an exemption if you sell your owner occupant property for, sorry, my kids are outside waving at me. They're dropping something off. Totally distracted. Thanks, James. For the distraction. So 250K is if you're single, 500K is if you're married. That's the exemption you get. So if you owned your owner-occupant house, you bought it at $300,000 and you were married, and then you sold it at $800,000, you would get an exemption of that $500,000 a gain. That's the benefit of being an owner-occupant in your house. So can you sell it tax-free if you move back in? Here's your answer. Partly, it'll be prorated depending on how much of the last 5 years was owner-occupied. That's all you got to know. Simple, easy, done. Consult a tax advisor before attempting this. I am not one, still not an attorney.
Yeah, don't do it and then have them try to solve, like fix the crap you did wrong.
Yeah.
Talk to them ahead.
Plan ahead. Some of the best things, like with the class last week in self-directed 401ks and with some of the complicated stuff that I'm about to teach on this stuff, go plan ahead. This is not like, oh, I'm selling a property and I'm closing in 2 days. Brian, you should get the rush fee and go pay that. Like, I knew I was going to 1031, I just didn't get it done. Don't be like me. So, buckle up. Can I 1031 into a REIT? This question is specifically for Nick, so if you're confused, talk to him after class, because after I teach this slide, He's going to tell you how it actually works. So you'll notice the text is small again. That's going to tell you about how long the slide is. So a REIT is a real estate investment trust. And lots of people want to invest in REITs. It's very easy. It's usually a source of passive income. The interest that you're going to get or the cash flow that you're going to get is probably lower than if you just bought a property yourself, but it's very passive. So REITs buy a lot of properties. They'll go out, I'm going to buy 100 properties or 1,000 properties, and they stick them in a portfolio, and then people invest in them, right? You buy shares rather than getting an entire property. It's not like you own one property in a REIT. You own shares, so little tiny fractional shares of all 1,000 properties. Returns come from dividends. I'm making these points now so that it becomes very clear that this is not a property. It's a security, right? Not rental income. Rental income is what we get when we own properties. It's a security. Securities are not like kind from our slide like 10 slides in. Securities are not like kind to real estate. So you can't 1031, right? Okay,
Maybe.
Slides over, right? Text, why is all this blank, right? Yeah, so you can't 1031 directly. However, there's some ways to get it done. You can go use IRC section 721, which is non-recognition of gain or loss on contribution to a partnership, and that is how you're going to make this work. And here's how that looks. An example of what this is, just so you can understand it, is that you would contribute a property to the REIT. Hey, I've got this rental property. You have this giant REIT. Do you want my property? And you give me some shares of your REIT in exchange for that. Chances that that REIT actually wants the property I have? Slim to none, or negative, right? Probably not, right? They're picking their own stuff to invest in. So what do? The REIT doesn't want our property. Instead, we exchange out of the relinquished property that we want to sell into a DST, which is a Delaware statutory trust, not daylight savings time, right? The DST is typically controlled by the REIT. DST investors own a pro rata interest in the trust. So when you buy in a DST, you get a proportional share of the DST. The IRS ruled in Revenue Ruling 2004-86 that a beneficial interest, which is what you have because it's a trust and you're a trustee, and then you're the beneficiary as well, you have a beneficial interest in that trust. So if you have that in a DST that owned real estate assets, which this does because it's a REIT, that would be considered a direct interest in real estate, which means it qualifies for a 1031. So you can take your stuff, stick it in a DST, and then use a 1031 exchange into the DST, basically, and use that to purchase a fractional portion of the REIT, of a property that the REIT wants to invest in. I'm going to restate that because that was freaking terrible. So you've got money, you've got a property, you sell your relinquished property. You basically 1031 out of that property, and you 1031 into this Delaware statutory trust. That Delaware statutory trust is basically used, because the REIT is in control of it, to purchase fractional portions of properties that that REIT actually wants. Remember, they didn't want your property, but they're like, hey, we just bought this office building. We're going to have you buy a fractional share of that building. So now you own a property that the REIT wants through the DST, and you 1031 into the DST. Following me? You're like, no. Shut up, Brian. So then 12 to 24 months later, because you got to wait, 24 months is the preferred one, that fractional portion of ownership of the building that the REIT wants to buy, they go, yep, we bought it. And in exchange, they say, here's some shares of our REIT. So in essence, you've now sold a property, 1031 into a DST, which owns parts of a property that the REIT wants to buy. And now it's just like in the first example. If they would have wanted your property, you could have said, here's my property, give me some shares of the REIT, but we have an intermediary step in order to get there. Make sense? Nick's your expert. However, be really careful. Once you do this, you own a security. You cannot go back. There is no go back to the DST and 1031 out. You're in a security. You're in a security that you don't control. Who controls the REIT? The manager or the sponsor of the REIT, right? So if shares of the REIT, you sell them, or the REIT sells a portion of those investments that you are now invested in, guess what? You're paying taxes on that. And you don't have control over when that happens. So taxes are going to be due. But this is how you get it done. James.
we're going to do a class on the Nomad REIT, where you nomad and then you transfer your property into a REIT when you move out.
Okay, good luck. So other online options allow 1031s out of investments. So in doing some research on the DSTs, basically came across some other things that were fairly interesting. So sites like Realty Mogul have actually gone and added 1031 investments. So you can actually take something that you're selling, 1031 your funds from a relinquished property that you own now, sell it, and basically 1031 into something on their site. Some of them are allowed 1031 investments, some are not. I couldn't find other sites that were just doing 1031s. The cool thing about this, you have to, well, this isn't the cool thing, but you have to be an accredited investor. So you have to make, I think it's $200,000 over the last 2 years each year, or have 1 million or 2 million in assets. You can 1031 back out of their investments, which is the cool part. So if you had to relinquish your property and you're like, I can't find a replacement, this is your solution potentially. You could say, my 45-day window is coming to an end, I gotta identify something. You identify something on their site, you 1031 into it, and then whenever that sponsor, because they're gonna have a sponsor, you don't have any control again, whenever the sponsor decides to sell, hopefully you get a heads up, and then you can 1031 off that platform back into a house or a duplex or whatever you want locally, or wherever you want inside the US. Or you just roll it on their site as well. The deal sponsor, like I just said, determines when the property sells, and you have no control. So they could sell it in 2 years, they could sell it in 5 years, right? So that's not a great thing. But if you were running out of time and you had, hey, I'm going to pay $80,000 in tax, it might be a potential solution for you. How to pay no taxes on real estate investing with a 1031. James, here you go. Buy an investment property. Use a 1031 exchange during your life if you choose to sell it. Replace it with other property. Make sure to trade even or trade up in value because you're not paying tax. We don't have boot. If you need cash, use the cash out refi after you've 1031, not right before. Die. That's the next step. Your heirs get to inherit your properties. Have a will. Make it easy for them. The basis of the properties, and this is what's amazing about real estate long term, right, across generations. The basis of the properties gets stepped up to the current market value. So all of that basis where you're like, hey, if I ever sell this, I'm going to owe, it gets stepped up to today's value. That's huge. Heirs may still have to pay income or estate tax. They can handle it. Don't worry. Because you're dead. I mean, why do you care? If the heirs sell the property later, they'll be responsible for any gain beyond that stepped up basis, just like any other kind of tax. Or they can do the same thing until they die. 1031, 1031, 1031, die, pass it to their heirs. Step up the basis value. And that's all I have. And I just want to point out I am 26 minutes early.
Nice. People are applauding you finishing early.
No, they're not.
They are applauding you finishing early.
I think they're just applauding. They're applauding that you're not taking pictures anymore.
That is true.
Yeah. Any questions?
Oh, wait. Questions?
So you've done I've done a 1031, and many years pass, and I sell the home, and I've forgotten about the 1031. Are there mechanisms in place to not let you forget?
Not let you forget in what sense? Like once you 1031 and you buy the replacement property, it's done. You don't need to remember past that tax year, right? It's taken care of on your taxes. You told the IRS this was the tax deferred transaction. And so now if you sell the property, your CPA has kept track of what the basis of that property is.
Oh, but I'm 10 CPAs past that.
That's fine. It's still on your taxes. It's in there. Yeah. It's just the basis of your property, which they're keeping track of in order to do your taxes each year, right? It's like the depreciation and all of that stuff, all the stuff that gets factored into basis. Yeah.
So way back, we were talking about how this kind of works in a hot market and stuff like that, like ours. Would it make sense if you were going to go through the 45-day process, so you sell your property, you do all that kind of stuff, and you're looking at properties, would it make sense to do something like a 1031 exchange when you had the funds to buy a house normally? So that way you could say, I'm going to try to do 2 houses at once, one of them can be 1031, one of them maybe not, and then I have kind of two offers going at once, or does that get you in a sticky situation?
I think as long as you're operating in good faith and your intent is to buy both properties, I think it's fine. What are you trying to prevent from happening?
So like basically like if you do have that crazy inspection thing happen, and then you're like, oh, I want to back out of one of these. When do I have to determine which property, if any, is a 1031?
So that's the rule, right? So if you chose hey, I picked 3 properties, I can buy 1, 2, or 3 of them, or if you picked the 200% aggregate or below, and you picked however many you wanted, and you're going to buy, at least some of them. Part of it is, if you're going to 1031 and you're selling a property in a market like this, selling your property is probably not going to be nearly as hard as finding the replacement property. So it would be my advice that you go and you put a property under contract, you get through your contingencies, and then sell your property, right? Or have your property listed as, hey, that's the property I want, I just put it under contract, I'm listing my property, and then go, right? So that you can adjust your dates. But if you don't have the property already identified, really and under contract, and have gotten through inspection, it's really tough. I mean, 45 days is just not enough time. But I mean, that's part of the rule, right? So got to follow it. Got questions back there too. This, again, it comes back to plan way ahead, right? Hey, I'm planning on selling this property next year. What am I going to buy in place of it? Am I going to 1031? Am I going to pay the taxes? What's the hit on taxes? What's my gain currently? Go figure all that stuff out ahead of time and then decide, is it worth 1031ing? Am I just going to take the hit and go forward from there? Mike.
For the 45-day period we're identifying properties, can you, instead of identifying the property and then getting it under contract, get the property under contract, go through some of that period, and then say, okay, everything looks good.
Absolutely.
I'm going to go ahead and identify this one.
Absolutely.
Okay.
Yeah, for sure. And in fact, I like that, right? I would much rather put it under contract. And if that's what you're saying, where I'm like, hey, I'm going to put this under contract and I'm either going to 1031 or I'm just going to buy it with cash or get a loan, like that's a great strategy. Because now you're buying it either way, you're operating in good faith. And if you can use your 1031 funds, fantastic. But if not, find the next deal to 1031 into. Austin.
Have you guys seen or heard anything about as far as like nomading and people trying to do that eventually? Because generally, like you said at the end, it's for investment properties. But then when you're talking back with intent, I've seen a lot of arguments online if people had it for a year and then for the next 10 years it was done as an investment property and that was the intent ahead of time. How is that handled?
Can you 1031?
Yeah.
Yeah, you should have no problem. But consult an attorney.
Once it becomes a rental, I don't think there's going to be an issue.
Yeah, it's just like the example where you move back in to have it prorated. So, I mean, I've not done Nomad, and so I don't know, and I'm not 1031 from a Nomad. So that would be a great question to ask. I guess next year the presentation will be 20 minutes longer because I got all these new questions to add to it. It's great.
When you were talking about earlier identifying a property and putting it under contract and then doing the 1031, do you then have to do that reverse one, or can you still do the delayed one?
No, so think about it this way. Like, you think you're going to 1031 with the property that you're selling. In fact, it may even be listed now, and you go and you say, I can either buy this property that I just found on the market and I think it's a great deal. I can either buy it with a regular loan, maybe I'm going to Nomad it, or I can buy it with 1031 funds. So you go put it under contract and you note in there, hey, I can do a 1031 if I want, and I'm going to get this as financing, blah, blah, blah. And then you go through your inspection and you're still within your 45-day period and you say, I'm through inspection and you've decided I am going to 1031. You just put that on your notification and say, this is the property I'm buying. But when you identify properties, like the 3 property identification rule, like if you're like, I'm selling this and I'm buying this one property and you're sure you're buying it, I suggest listing 2 other properties on there anyway. Find 2 others that you think you might want to buy in case that first one falls out, because after that it's really hard, especially obviously if you're past the 45-day window, you can't change it. Other questions before Nick answers all your questions about DSTs and REITs? If this is a question about REITs.
Can you 1031 out of a property to pay off one of your other properties?
Good question. That question came up last year, and I should have put it in the slides. So no, You can't, you're basically paying off a loan, right? You're not actually, it's not a like-kind exchange. You're basically pulling money out to pay off a loan on a different property. So you cannot do that. Yeah. Royce.
Is there an arm's length requirement to? Is there an arm's length requirement to identifying the new properties?
In what? Yes. I mean, while you were signing your contracts, we were discussing that. Yeah, you should consult an attorney, right? If you're like, if I'm buying a property from James and I'm 1031ing into it, we should go talk about it with an attorney and make sure it's truly arm's length and he's not pricing it to me at, you know, higher or lower or trying to skirt some, you know, law or whatever. Like you just you're not trying to violate stuff like that. Any other questions? Perfect. Oh.
Okay, so if you're sitting in a hot market like we are right now, and you've got 5 buyers, and you're the only 1031 exchange, are you at an advantage or a disadvantage?
You're the only, like you're selling your property?
Yeah.
Or you're buying
and everyone else has cash, let's say, at the table, and you're 1031ing it. Are you at an advantage or a disadvantage? Disadvantage, sounds like.
I mean, if you just have in the contract that you might 1031, I don't know. I mean, if people are paying cash and it's like, I'm closing in 7 days, then you're at a disadvantage just versus a cash buyer, just as if you were getting a loan. But if you already have your funds and you can close, then maybe not. I could see it both ways.
I could see if I'm representing the seller, then I think I have some leverage because they are motivated to find something.
Yes. So when if they're coming up on their dates, that's when you have leverage, right? So if James sold his, relinquished property and he's nearing the end of his 45-day period, and I know that, and he's 1031ing, even if he's got cash to pay it, I can be like, well, I've got 3 other people that are interested. If you want to buy it, it's $500,000, but if you really want it, it's $570, right? Because he's going to save on taxes way more than paying the extra $70,000 that's going to get paid off on a loan over time anyway, right? And I mean, I've been through this, right? And I would have been willing to pay substantially more, as James knows, because he was a jerk and pranked me on the phone. It's like, you got the offer, but you have to pay $50K more. And I'm like, okay. It was just no thought. And then he's like, I'm just kidding. I just made an extra $50K. And I'm like, it's like, yeah. Worst conversation I've ever had when I was already stressed and at the bank. Yeah. But I think in that situation, right, you're willing to pay $50,000 more for a $900,000 property to save paying $70,000 in taxes. It just makes sense because that $50,000 is basically just going to be extra loan that gets paid by the tenants as long as the property is actually worth that. So there's some weird trade-offs you make. Michelle. You can ask it anyway. Other people might have the same question.
It's 45 days from the date of the sale
of, the
of your
relinquished
home.
property.
Okay, yeah.
Yep.
I was thinking it was listing at first. So
Nope. Yeah, so the range of time I gave you was it's 45 days from the sale, and I said, so if it takes about 45 days in a hot market for you to sell and close, when you list, you probably have about 90 days to get your identification done and turned in.
And if you're in a really strong seller's market, you may be able to negotiate additional time before you close so that you have time to find your replacement property. You could say, listen, I'd like to close within 30 days, but I need to find my replacement first. So you're welcome to go under contract. I will sell it to you, but it may be a delayed closing. Are you okay with that?
Right. And if you're willing to actually delay your purchase for someone who's looking for a 1031 replacement property because they don't want their closing to happen, you have some leverage and you have an advantage with your offer. Hey, I'm not moving in. I'm trying to buy it. Whenever you want to close, I'm good. And we've seen some crazy stuff where it starts to be, somebody's selling a duplex to buy a fourplex, but the fourplex is going to 1031 into a 10plex, and the 10plex is going to 1031. And it's kind of like this, everybody needs to have their deal lined up. And so you have some leverage in those situations.
I just have a quick comment. We're very lucky. We can still do Section 1031 exchanges, and maybe we need to thank the RPAC because tax reform totally eliminated Section 1031 exchanges for every everything but real property held in trade or business, including the fact sports franchises now, when they trade players, have to recognize taxable gain on like-kind exchange when they trade players. I just verified that again with the recent AICPA article. So let's all feel sorry for sports franchise owners.
Or not. Yep. Any other questions? Awesome. Well, thanks for coming. Stick around for the class after the class, and we will see you later.